Well, hello everyone. Thanks for coming when it's so gorgeous outside. Hopefully it'll still be light out when we're done. Otherwise I talk for way too long. Whether it's finance or HR, it's all about growing and running a sound company. So just super quick background on me. I'm head of finance at Lighter Capital. I've been there for about 4 years now. So we are a tech-enabled lender to early stage tech companies. Companies are generally about like 2.5 million annual recurring revenue when they come to us, and our goal is to help them grow and retain equity, right? So if it's hard to raise equity and it sucks giving a part of your company away to a VC, so our loan structure enables an entrepreneur to keep that ownership and grow their company. It's not about understanding the balance sheet, but I think it's just really fundamentally what happens in a company, right? And you can learn that from the financial statements. So how does a company make money? Everybody needs to know that at where they work, talking the similar language of other people in the room, becoming a partner with business leaders instead of just proposing ideas that are kind of far out of left field or always a little bit off from what everybody else thinks. If you're a partner, I think it's easier, you're just on the same page and you can help move things forward. And then really, how can HR professionals help ultimately with the bottom line? So there's 3 different the outputs that describe the financial condition of a company. The balance sheet, the income statement, which you probably also heard of as the profit and loss or the P&L, and the cash flow statement. The cash flow statement is kind of a funky one because it really describes the interrelation between the balance sheet and the income statement. The balance sheet. The balance sheet is a snapshot in time of a company's financial position. And by that I mean it's as of a point in time. So you have your balance sheet as of May 7th. Just so you know how a balance sheet's laid out, it starts with assets, goes into liabilities, and owner's equity. Always looks the same. So what does a balance sheet talk about? 3 things, right? Assets are what you own. The most obvious asset is cash. I'm guessing most of y'all are in tech, but if you had a bunch of inventory, then that's an asset because you own it, right? And liabilities are what you owe. So if you have a line of credit from a bank and you pull on a line of credit, you owe that to the bank, and so it's a liability. Or accounts payable. When I get a bill from Jenny, that's what I owe her, so it's a liability. And then equity is really everything else. That's like the value of what the owners have in the company. And the thing about a balance sheet is this is an equation. So the assets, what you own, equal what you owe and everything else. And so to dive in a little bit deeper on the components here and what it generally looks like at an early stage tech company, I guess, right? So assets can be broken down into current assets and long-term assets. And the difference is time. So if your asset can be turned into cash or is liquid within less than a year, it's current. Accounts receivable. So this is what other people owe you. So we're in the lending business. So every time I make a loan to a company, they now owe me that. So it's an asset. They owe me that money back. If you provide a service and send somebody an invoice, that becomes your account receivable, and somebody owes that to you. Inventory, like I mentioned, those are the real 3 usual suspects. In tech companies, you're not going to have inventory, so it's really just cash and accounts receivable. If your customers don't pay you when you want them to, it's called AR aging, accounts receivable aging, and it's a sign of health of the companies. And then in terms of long-term assets, these are things that aren't liquid, that can't be turned into cash. So the usual suspects are PP&E, like property, plant, and equipment. Again, tech companies don't have much of this besides the laptops that are on the desks. You might. And then goodwill is the other one that we would probably see in the tech world. And this is the soft, kind of squishy, intangible stuff. And the easiest example is if you buy a company for $100 million and they're really worth 50 and you paid 100 because you wanted to acquire them really badly, the $50 million difference is what you book here as goodwill. And you better hope that you can make that thing pretty valuable over time. Otherwise, this shrinks and you have to take it off your balance sheet. So then moving along, liabilities are what you owe, right? So same concept, current and long term. 2 easy suspects for liabilities, notes payable. So this is if you have debt, if you got money from a bank and you borrowed. Lines of credit, because you have to pay those back quickly, or in the current portion, if you got like a long-term loan, the portion that's due in years 2, 3, 4, 5 would be the long-term part. And then accounts payable, right? These are all your bills. And then the long-term parts, like I said, is debt. And then the everything else bucket, right? So in equity, if you're looking at a balance sheet of an early stage tech company, you're going to just see stock. Really, stock could be as simple as common and preferred. Preferred are like the VCs that put money in your company, and common is everyone else, so the employees that executed their options and stuff. And then retained earnings or loss. So this gets in a little bit of the relation between these financial statements, but when you're a profitable company and you make money, that starts to equal the value for the shareholders. And you could do two things with your profit. You can reinvest it in the business and hire people or buy machines, or you could pay it out in dividends to the owners. When you're keeping it in the business, it shows up as retained earnings for that period of time that it's still in the business. So how do you put all this together? In terms of how do you analyze this and how do you think about it, you can look at trends over periods of time. That's kind of the most easy and relevant thing to do with a balance sheet. Now, this doesn't tell me what happened. If cash went down, I don't know if I hired a bunch of people or I bought a bunch of inventory or whatnot. And then ratios between two categories. So this is interesting, right? So you could start looking and really trying to understand what's going on in your balance sheet. So a really common ratio is called the quick ratio, and it looks at your current assets versus your current liabilities. Why is this interesting? So your current liabilities are what you owe people in a year, and so you want to look at, well, what do I have that I can use to pay them back pretty quickly? So, and then debt to equity, you've all probably heard of leverage, right? How levered are you? So that's how much debt you have in your company relative to the equity. And it gets dangerous, right, when you have so much debt because you don't really know how you're going to repay it over time. And then the other thing it's relevant is just what's the absolute number of any one of these categories. So a company probably wants to make sure they have some amount of cash in the bank at all times. And if they're under that, then the alarm bells go off. And minimum liquidity, if a bank gives your company a loan, there's going to be some threshold that says cash can't go below this number, right? Or you might have committed to your board that we'll have fixed this before this cash gets to this number. And also with debt, right? You probably don't want debt to exceed some absolute number just because it doesn't feel right. It's not safe for your company. Next statement is the income statement, and totally different than the balance sheet. The income statement shows performance over a period of time. So it has a beginning point and an end point, and it talks about what happened between those two. And the main things here that you probably already know, right? It talks about your top line, your revenue, your sales, your expenses, what did you have to pay to generate those sales, and the difference between the two, your profit or your loss. So what are all these components in the income statement? The income statement always starts with sales and revenue. An income statement generally is created on an accrual method, which essentially means that it's based on the activities that happen in a period of time. It doesn't matter when you got the cash. Just because she's booking $100 in January, that doesn't mean anything about her balance sheet. She has no cash. She's going to have accounts receivable. But just saying she had a great January, that doesn't mean she actually has any money to do anything with her employees or hire a bunch of people or whatever. That's kind of a key takeaway here, is that it's about the activities that happen in a certain period of time. It doesn't matter what cash did. And then moving down, you have your cost of revenue. Cost of goods sold, COGS is a common term. And this is the expenses you had to incur to generate $1 of revenue. Right? So if you're a consulting company, you can't generate revenue without sending a person to do the consulting work. That's going to be part of your cost of goods sold. Your rent, conversely, has nothing to do with your ability to generate $1 of revenue. So your rent is going to be down in operating expenses. That's just what you got to do to run the business. The difference between your revenue and the cost to generate revenue is called gross profit. If you're scalable, if your gross profit's high, right? You don't have to pay that much to grow this company to be really big. So then I kind of mentioned operating expenses is really everything else. Salaries, developer salaries, marketing expenses, rent, all that kind of jazz is down there. And then if you take those out from your gross profit, you get your operating income. The operating income is kind of the number you'd focus on. Below that are kind of the other things like taxes, but if you're not profitable, you're not paying taxes, so nobody really cares about that in the early stage tech world. And any other expenses, and that gets you to your net income. Everything is just kind of subtracting all from the revenue on the top. Yeah.
Yeah. So for your example of products versus services, in the cost of revenue, would the overhead of a services business, would the labor and payroll go in the top number if it was a services business, and in operating expenses if it wasn't?
Yeah, great question. So most people don't really parse it out that detailed, but you're supposed to. So cool. So how do you analyze an income statement? Performance over time. So the easiest one is saying we made $1 million in Q1 of 2019, and we made $500K in Q1 of 2018. We're doing better. And you could also do the same versus your budget. So if you made $1 million in Q1, your budget said you're going to make 1.5 million. What went wrong? Why did you miss your budget? The other interesting part is you can break down all these pieces, kind of to Jenny's question. Nobody's P&L is as simple as just saying revenue. So it's going to say product revenue and service revenue. And you could see the mix and the trends of that over time. So perfect HR example, if your whole goal with the management team was to start getting product revenue. You were only a services business, and you went and you recruited and you tried to train a bunch of people to generate that other part of your revenue. Well, over time you can monitor, is that actually coming, right? So let's say we're all services revenue, and the next quarter we're 90% services and 10% product, and then 80, 20, and you're moving in the right direction. You're like, well, okay, I'm helping, and our company's evolving as we want it to. If that revenue never transpired, you're like, oh, like, hold on, something's not working. We're not meeting our goals, right? So again, ratios between the categories we talked about, like gross margin, expenses versus revenue, revenue per employee is a common one. Revenue per sales employee. If you think about ramp-up periods, so you're going to have some revenue target in the first couple months, and then once somebody's growing into their position, they're going to have a totally different target, and you could start kind of parsing this out over time. And again, absolute amounts, just like the balance sheet, become interesting. I said I was going to make this much money this year versus my budget, or versus last year, both with revenue and expenses. I'm on the cash flow statement. It translates the two. So the example I said where Jenny bills us, I get a bill for $100. She books her revenue. She doesn't have any cash, so she books accounts receivable. When she gets the cash, her cash goes up and her accounts receivable goes down. And you get to see all those inflows in your cash flow statement. Three main portions to it. How does a company generate cash? You do it from operating activities. So this is me paying Jenny. That's her core business. Accounts payable is just how you run your business. So if your accounts payable goes down, that means you paid your bills. That means your cash went down. And so that's what the story is being told here. Cash from investing activities, not super relevant for the tech world, but if you're running a plant and you buy a big machine, you spend money to purchase the equipment. And then cash from financing, this is where if you get a big VC investment or whatever, you're going to see a big pop here, or if you take out a loan from a bank, those are considered financing activities for your company. And cash flow statement is over a period of time too. So one of the biggest things, right, and especially as you're growing a company, is the difference between being profitable and being cash flow positive. It doesn't matter if your P&L says you're profitable if nobody pays you because you have no cash. And that's what you need the three statements to do. This is like the silliest question when you're a first-year analyst out of undergrad at like a bank. They're like, which is your favorite financial statement? It's a dumb question because you have to have all three to understand the health of a company. You want to be cash, in my opinion, it's better to be cash flow positive than positive net income because you have cash. The other part is how did you generate your cash? So you looked at somebody's balance sheet and they had $1 million last year and now they have $4 million. Cool. Like, are they a super successful company and their customers are paying them? Or did some VC just give them a bunch of money because it's their uncle's friend and that's it, right? So you'll see it here because you'll see increase in debt, right? Cash burn in an early stage tech company, that's the most important thing that everybody cares about. And that's what the cash flow statement's gonna help you look at, your operating cash burn. And you're really gonna try to figure out what are we doing in terms of our cash, and how is the burn hopefully coming down over time? How are we able to have our customers pay us or reduce our expense structure so we can stay in business and ultimately become cash flow positive? And then financing, like I kind of touched on. So when your cash goes up, well, why did it go up? If you're looking at a company, is it, again, right, either you're generating it from within the business, or somebody invested and bought a chunk of your company, equity, or you're taking on a bunch of debt. So I just put some high-level thoughts I was thinking about in terms of at least how I work together with HR and what might be relevant for the group. But first thought was around cost analysis. So you kind of just hit on it in terms of revenue for based on revenue for employees, but also what are direct employee expenses relative to overhead. So we stock our kitchen with a ton of stuff, and it makes everybody really happy, and that's really important to recruiting and retaining our whole company. You don't want to just look at the P&L of your company and look at the marketing expense and say, oh, this is way too much marketing dollars, this isn't efficient. You got to really unpack it and understand what's in there. what's relevant for people or generating revenue, and what can we cut because it's not really adding to the value of the company. Another bullet here is kind of the difference between gross and net. So is the revenue per employee important? As you're a growing tech company, revenue is usually the metric that everybody cares about. As you mature, the profit becomes pretty important, right? So after all the expenses, but just kind of trying to think through those different line items, and it totally depends on the stage of the company and what your investors care about. Ramp up of employees. Nobody's productive on day one, so how do you actually plan this out? And when there's a budget, the marketing's going to hire however many people over a certain time period. Well, okay, you're going to bring them in, but you need to work with finance so that everybody knows that if somebody's budgeting a huge pop in revenue in like a month, it's totally unrealistic. And that's going to differ across teams. So you're going to start paying salaries tomorrow after you hire somebody, but then really thinking through the ramp up and what does that mean in the different financial scenarios. I don't see how anybody can nail like a full year budget when you're like in your second year of a company. It's impossible. So you just have to be iterative.
The ramp period and the impact on the existing team. So we try to talk to them about considering when you're bringing on new people, that might hit the productivity of your existing staff. So how do you work that into your...
Interesting. In terms like they have to train them and answer questions and babysit them? That's interesting. I think then you start just looking at it in terms like an aggregate, right? You can't say like, oh, Joe's going to be a little bit less productive for the next 60 days, but like Jim's not going to be affected. I just look at the team as a whole. And if you say we're going to add this person, they're going to ramp, but the rest of the folks might slow. So let's just be a little bit slower in our growth projections. A couple other bullets I wanted to touch on. So the importance of like delayed progress payments, right? So to the extent that you're negotiating contracts and you're thinking about ramp, so not everybody's super productive. So what do? You need to manage your expenses because that revenue is not going to come quickly. So try to pay it over time and just conserve cash and it's really hard to get a refund, right? It's just a lot easier to be like, your service sucks, I'm not paying you the rest of the bill. So I think that's an important one in terms of cash management. And then in the timing of expenditures, somewhat related to that. But HR, even since we've brought on a director pretty recently, she's like pushed our leads to do things that they might not be comfortable with doing. But she's done a good job of understanding everyone's like sensitivities and everything. Said differently, she's able to convince us to spend a little bit more money now that we didn't want to because we can see the business case. And so we can kind of understand different timing scenarios. And then flexibility in contracts, right? So never locking in like super long-term contracts and trying to get them to tie to the growth of your company, right? And like when I talked about knowing how your company makes money at the beginning, another concept you might hear about is the unit economics of your company. So this is essentially like breaking down this whole concept of the income statement and everything, but at the end of the day, what are the components to every dollar the company makes, right? So if I make $1 in sales, I have to pay 50 cents to my inventory supplier, and I have to pay 20 cents to this broker, and I have to pay 7 cents to a salesperson, and I get to keep the difference. And every early stage tech company should know this because that's what people care about, right? And your unit economics have to work so you can scale. So I think as HR leaders, really asking what are these unit economics today, and where do we want to get to? Because the unit part of unit economics is just like for every individual sale we're making, right? Where does that money come from, or where does it go? Why does that matter? You guys can partner with the business leaders to help improve what you're making from each individual one. Your people are more productive. You're finding better folks to sell it to. The process could be more efficient. You're training people in a different way so you can save money. It's a buzzword, but it's super important, and it's a really good way to understand at the most granular level how your company makes money.
So one of the things I find has been the trickiest is measuring performance of a sales force, right? And so you indicated in there that, of course, revenue per employee. Are there any other different, dimensions that could be evaluated that you found to be really effective, particularly in a more mature organization?
So with sales, you could start thinking about LTV, like lifetime value. So it's not about just making one sale, right? It's about keeping that customer for a really long time, because you have to invest dollars to get the customer in the door. It's a lot easier to do the repeat sale. So one of the easiest metrics is it's called LTV, right? So you make the sale and then you upsell them and upsell them again and again and again. And those incremental ones, it didn't cost you that much. It might have just been a phone call, right? But that customer that they brought in 3 years ago is now, it used to be 1% of your revenue, and now it's 3 and 7 and stuff. So looking at that whole LTV. If you have a salesperson, then you're measuring them on deals closed, but like all the customers, it's called churn, like all the customers quit, like something's wrong, right? Or your incentive comp is wrong, though. Seriously, though, that's probably the problem. At least in my experience, like our salespeople do exactly what our sales comp says. Like we used to close all of our loans in the last of the quarter because we had a quarterly comp plan. Then we made it monthly. Every end of the month was crazy, and now we have like bi-weekly. Figure out what you want with your business. If you want to retain customers for a really long time, then you need to compensate your salespeople to get those renewals. And thanks everyone for thank you. I appreciate all the thoughtful questions and everything. Happy to help if anything pops up. Like reach out, or if your company wants a little loan, let me know.